All right. Hi, guys. I'm here today with Rick Morello of HIS Capital. They do a number of large deals and small deals in the real estate sector, along with institutional partners. So, what I'm excited about today is that they've got an opportunity for investors that aren't even in the United States to invest in US real estate with as little as 5,000 US dollars. So super excited to learn about how that works and how people who aren't sophisticated investors can get in on these deals. So, Rick, what do you call this program first?
Yeah, perfect. First of all, thank you so much for having me. If you really take a look at what we are, is we have basically a public fund that allows us to bring investors from all walks of life. Some are accredited, very sophisticated investors. Others are coming from different parts of the world. But the real bridge here is that investors from all walks of life can jump into this fund and invest in a variety of different projects for as little as $5,000. So that's basically what the program that we were looking to build. Took us over 17 months, of course, to get approved by the Securities Exchange Commission, but it created this beautiful opportunity for us to be able to focus on a portfolio approach. So we do a variety of projects, and investors partner with us through this fund to be a part of all of those deals.
Awesome. So, what kind of structure is that you have to go through the process? What kind of investment is it? The
Yeah, well,
technicality.
it's a host of different investments. If I can kind of give you a picture. Now, of course, we have what we call our directive active projects, meaning these are projects that we source, we acquire, and we oversee all the way to the finish line. We also have some of our passive investments, which might be in partnership with operating partners. And then there's a higher level, a higher tier of these kind of investments, which we call club deals. And these are projects that are a lot larger. They have some form of legacy play. They're very exclusive. And from time to time, we'll select the right opportunity to incorporate in our investment strategy. And we're able to work on some really substantial projects that investors in our fund get to benefit from.
Okay, it sounds really cool. Can you tell me more about what exactly a club deal is and what the significance of these deals are?
Absolutely. The club deal has become kind of an institutional, word, if you will, a buzzword. And it's basically where different institutions that are family offices, extremely wealthy families, and even private REITs and hedge funds come together and they collaborate in like this exclusive network. And what they do is they source for opportunities that really have not been available anywhere in the marketplace. And so this group of individuals and funds come together, look for opportunities that are in alignment with their vision, their mission, and their legacy play. And then they work together towards taking down these substantial projects. That's really what it comes down to. So really, at the end of the day, when we get involved in projects like this, we find that number one, they're extremely exclusive, really hush hush. Not many people are aware of them, but these particular groups. And what I mean by large projects, some of these projects are the billion-dollar deals that you hear about on the news later on. Hey, this monster project took place. They're building X amount of community. And you hear it in the news going, my goodness, that's incredible. Well, generally, by the time you hear it, the club investors have already partnered up and put the funding together to get that kind of project in place. And so it's really good. Again, like I said before, there's a legacy play. Most of these projects have some level of legacy that these extremely wealthy families or investors want to leave behind, if you will, with this project. So it's got some form of signature, some type of purpose behind it. Most of the players in this particular club deal are going to be extremely qualified sponsors. They have experience, they have a history, and there's a lot of wealth behind it. So again, these aren't necessarily projects that are for starters. These are projects that are very, very sophisticated. And most importantly, these are projects that, like I said earlier, they're very exclusive. So these are opportunities that most people only hear about in the news after the fact. During the time of due diligence, these guys are collaborating to make deals happen. So hopefully that kind of gives everyone a picture of what a club deal really is in our space, in our industry.
Okay, so that sounds really cool, but what I'm concerned about, but curious about, it sounds great from the family office and the large institutions perspective, but what has that got to do with mom and pop investors?
Well, it generally isn't even for mom and pop investors, really. I mean, again, it's made to be a project where they don't have to worry about the level of sophistication of the investor. We're the ones that have been trying to come up with a solution that creates a bridge between that mom and pop investor to be able to partner with us in projects that we're investing in these types of club deals with. And so that's really what it comes down to, because the way that we wrote our fund, it allowed us to diversify our portfolio approach. One of those strategies being that we're looking for sponsors or family offices or institutional partners who are already sourcing deals that are exclusive, that fit our particular box of investment strategy. And so really, it's not meant to be for the public, but we're creating a bridge that allows the public to participate passively in those opportunities, if that makes sense.
Okay. So how do the sponsor and family offices source for these deals and their capital?
Over the years, we've been doing this now for 20 years. And so what I've learned over the last 20 years is that this is a very exclusive elite network that collaborates. And so it took us quite a bit of time to get to the level where we were kind of brought in by referrals primarily. And so really, when you take a look at this particular elite group of people that are kind of coming together, it takes time to get to that book of business and to be able to collaborate. Now, one of the things that I've learned about within the years of doing this is that most of the people that are in this, quote unquote, inner circle, they either have contacts already that have been in the industry for many, many years. I mean, some of these are generational wealth. So these are families that are 200-300 years old in the industry, right? And so what you find is that some of these landowners that have owned thousands of acres have been a part of these networks for years. And when the historic cycle begins to pivot and change and you get to a growth cycle, then all of a sudden this piece of land that nobody even knew would be available becomes some form of either sale or in a partnership with a club deal investment that then all of a sudden develops these projects. And so that's primarily the way that these opportunities come about. And again, most people are not even aware that for the last 20 plus years, people have been slowly assembling these portfolios or these blocks of projects that are going to be extremely monumental and very profitable.
So you guys have just invested in a project yourselves. Can you tell us a little bit more about it?
Absolutely. So we actually have, again, been building relationships for years. And one of the off-market projects that we're working on is over a 300 plus unit apartment complex. In fact, in this podcast, we'll share a link. It's actually with our investment platform that we use to bring investors into the fund. Now, that particular project's already out. We can't take on any more investors, but this gives the investor the opportunity to kind of get a picture for what these projects could look like. But just to kind of give you a basic piece of why we were attracted to this particular deal and why we invested. The very first thing was it was a very much off-market opportunity. Nobody was even aware of this. Only in a small circle of people were there talks about this project as it was coming to fruition. The other piece that I found that was really powerful about this deal, especially in this market, when you hear about multifamily deals and institutions or investors like branded names that are out there buying these deals, most of them are buying them retail. So they're very, very low cap rates when they buy these projects. And then what they're hoping is that through inflation and incremental increases in rents and management, that they're able to then increase their overall cap rate. Well, I don't believe in that philosophy. So from our perspective, this project fit the bucket because of the fact that it had a couple of components. Number one, we were building at a price that really hedged us because we had a lot of equity built into the project. In addition to that, when we ran the financial numbers on the income stream, which I'll talk about in just a second, the income stream was incredible, and there was an amazing exit strategy. So we felt that it really hit all the balances, if you will, because we're looking at deep discounts. We're looking at specifically the control and basis, which is basically keeping a strong margin and also making sure that we have the intrinsic value truly in place and that we're below that intrinsic value. Now, the numbers are pretty straightforward, so I'll kind of give you a picture. So the total equity, this is the amount of investor capital that was put into this project, was $17.8 million. Now, total construction project, land and development and everything else, all in was roughly $69.8 million of that 17.8 in equity. But what was amazing in the diligence process is that we were able to really get an appraised value of about $122.7 million when the asset is built and stabilized. And so what that means for us is that when we lease up to even a 90% occupancy rate with these brand new construction projects, what we're able to expect is about a net operating income of about $5.1 million, which basically means that if we paid all cash for this deal, we're looking at a 13.7% annualized. And what we loved about this deal is that when we started analyzing that particular market, other insurance companies and institutions are buying these stabilized projects at a 5 cap. And so we felt extremely confident that we had a really solid deal with great returns, that if we needed to keep it, we could, because the cash flow is there, but the exit strategy is incredible. And so again, this is one of the elements that really made sure that we were really drawn into the deal. In addition to that, of course, we did our due diligence, and we felt very confident that the guarantor and sponsor partner not only had the liquidity, but other like projects that they had done together in the past. And so that really passed the muster for our due diligence process.
Okay. For those that aren't aware of industry terms, what exactly is a five cap?
I'm sorry, say that again. I didn't hear you.
For those that aren't aware of industry terms, what is a five cap?
So a five cap, so it's called a capitalization rate. And the simplest way to put it is when you are estimating a commercial asset, you're valuing it not just on replacement cost or sales price in the industry, you're also analyzing it based on the annualized income that you generate and what profit that looks like for your investment. So for example, if you were to buy a project and you're looking to make a 10 cap or a capitalization rate, that means that if you're buying it for $1 million and you want to make it 10% annualized, that property would have to net a minimum of $100,000 a year after operating expenses. And so in our particular investment approach, what we're saying is if we're putting in $17.8 million in this project, at the end of the day, when it cash flows, we're expecting a 13.7 cap, which means we're getting a 13.7 return on our money annually based on the net rental income. And to sell it to an end user, that creates the opportunity for us to be able to sell it to them at a 5% return. So that means they're going to pay a premium for that asset because they have a longer term vision, a longer term goal for this project. And so it just creates a great exit for us and an incredible opportunity if we hold as well.
Brilliant. I guess the next question here is what kind of due diligence do you guys do to see if this was a deal that you wanted to get involved with?
Yeah, so I mean, obviously we talked a little bit about the summary of numbers, and I'll be honest with you, this process for a club deal of this size, it obviously takes some time and due diligence. And so if I can kind of streamline it for most people to understand, because obviously I know there will be some sophisticated clients, but you might have some investors that this is like their first conversation about a multifamily project that's worth over $100 million. And so, you know, what we really boil it down to is we look at some of the core essential elements of the risk and of the opportunity. And it begins with the sponsor and operator. And I like to quote Buffett because obviously he's one of the most brilliant investors on the planet today. And if you look at his philosophy when he's investing in business, what you will find is that he's always looking at the intrinsic value, but even further, what he looks for is the management team. Do they have experience? Do they have the potential to really take this business to that next level in order to grow the value? And so one of the first elements of our due diligence was really doing our due diligence on the sponsor or the operator of this deal to make sure that number one, do they have the track record? Number two, do they have the reputation of performance? Number three, what is the background and liquidity that we see? Does it pass? And so in our due diligence process, this particular sponsor passed the muster, if you will. From there, we said, okay, well, now that we're good with the guy that's running this deal, let's take a look at the market. Are we comfortable that this is the right time for a project of this magnitude? And so we did basically what we call a market feasibility study. And that passed during our due diligence. We used a third-party company to give us all of the indicators that are going on in that localized market because real estate is hyper-local. After that, we talked a little bit about what we call a builder review, which is a part of, again, our due diligence. And what that means is, while I might like you as the sponsor, Joss, at the end of the day, if you have the wrong contractor for the job, that could equally impact our ability to perform or meet deadlines or stay on budget. And so we also use a third-party company to do what we call a builder's review. That particular builder that was being hired, that contractor, passed with flying colors throughout that due diligence process. So that was essential for us. Another piece that then we do now is we start saying, okay, well, now we're good with the operators. We believe this is a product that's needed in the marketplace. This is the right time. So now what is it worth? And so we started really taking a look at, will the market support this project? What is it worth? And what is the income really going to look like? And so we used, again, some analysis tools to really get comfortable with the values that I just talked about. We felt confident that $122 million was a legitimate value on the asset when stabilized. When we ran the numbers at a net operating income of $5 million a year, we were very confident that those numbers match. And in fact, we put a fudge factor there because we were analyzing at a 20% vacancy rate on brand new construction projects. So that was another essential element of our due diligence. Another thing too is we did what we call a stress test. And if you look at a lot of financial institutions, FDIC does stress tests on banks to say, hey, if the market were to have issues, what is your ability to perform even in the worst of circumstances? So we actually ran the numbers back and put it through a stress test, and it passed. So that was a very important component to this particular due diligence. Now I can go on, but I'll say we looked at title, we looked at the proper insurance, we went through the process of understanding how the exit strategy is, what are some of the potential buyers, because generally by the time you build this, you've already had talks with other institutions that are looking for this particular turnkey inventory, and those talks have been going on in addition to talking to the banker. Because if you remember, I talked about a $17.8 million investment, but the total project is $69 million. So where's the difference coming from? Well, between the investors that are the operators and a bank, that's how we're leveraging to be able to increase our return. And so we had those due diligence talks as well. And so there's a host of things that goes on, but in essence, those were kind of our formalized approach of clearing, if you will, to make sure that we felt confident about this opportunity.
Interesting. Question from here is, how can a small investor participate in these 300 plus unit projects like this one?
Yeah, absolutely. Well, obviously, if you're an accredited investor or you're an affluent person, you might have some similar opportunities that are available. But generally, these type of club deals, like I said before, you have to be what they call in the industry a qualified purchaser. Okay, that's really the term in the industry that is used. And generally, for you to actually be an individual that fits that category, you generally have to have at least $5 million of liquid capital to work with this group, okay, or these individual institutional groups that are looking for these opportunities. And so it kind of makes it a little harder to find these kind of deals or to even fit into that, because not many individual investors have the $5 million to even step into the game to begin with. But I also want to kind of hint to something else. What we learned over the years is that it wasn't even just about the money as well. Another element for these groups is, do we have an alignment of interest? And that is essential. I'll give you an example. So this particular project that we're talking about specifically, one of the things that linked us wasn't just a liquidity investment opportunity that we have with them, but the fact is his capital is really focused right now on finding innovative ways of investing in real estate. Part of those innovations are, how do we tackle the affordability crisis that we're dealing with in America right now? And how do we deal with a product that we're developing that doesn't impact our planet any more than all these new construction projects that are out there? So the alignment for us wasn't just the money. The alignment had to do with the fact that we were going to build affordable luxury housing. And in addition to that, it was truly a green project. So it was going to have minimal impact on our global impact that most projects have. And so that's another key element that aligned us with this particular project and allowed these investors to take us on as their partners in the deal as well. Now, for everyday investors, you can look for groups. There aren't many that do what we do because they usually like to keep it exclusive. But that's been one of our missions, is how do we bridge between the institutional level investment and the individual investor. And so investors can join our fund for as little as $5,000, and they can participate in projects just like the one we're talking about today.
Final question. If anyone wants to reach out to you to learn more, where can they go?
Absolutely. So if they're interested in learning more, what I would highly recommend is, I believe in education, it's essential. And so if you haven't done this, or if you've done very little projects, I would encourage you to go to hiscapitalgroup.com. When you get to the website, there's a button that says free education. And what you'll notice as soon as you click it is that it gives you two options, and that is US investors and overseas investors, because overseas investors have other things that they also need to consider that in America we take for granted as US citizens. And so we've broken down our content into those two key components. And I highly recommend that if you haven't done something like this, that you first educate yourself, understand the risk, understand the upside, and understand the due diligence. So I would highly recommend you to do that. Now, if you already have experience and you're just looking for immediate opportunities, also on that same page, actually right in the home page, you'll see a button, and that button gives you the opportunity to participate. It literally says see our investment opportunities, which will link you directly to our Fund 3 platform, where you can literally click and invest.
That's really cool that you've integrated an educational approach to your business. Love that what you guys are doing. Rick, thanks for your time today. Hopefully we'll be able to connect again soon.
Absolutely. It's a pleasure again, Josh. Thank you so much for your time as well.